Good evening, everyone. I hope my voice is audible to all of you. May I get a quick confirmation over the chat box? So, I hope everyone is doing really, really well today. And welcome you all to the grand revision of strategic business reporting. And today we are going to revise certain important IFRSs which can be tested in your attempt. So, I am not cherry picking IFRSs on the basis that I think they will be tested. It's just that these are a little complex standards and they're very repetitive in the exam. Okay. So I'm not going to teach you those basic standards like IS 16, IS 40, IS 38. That is still something that you guys remember from your FR knowledge, but we will just have a little brief around those standards. So, as the name suggests, today we are meeting for grand revision. And let me put out certain rules for the session. And the first rule for the session goes unsaid that this session will be recorded and it is to be provided to you via my YouTube channel. That is by the name of Tashwita Gupta. Okay. And the handout, that means whatever I'm typing on this Word file will be shared with you over the same YouTube video and it will be shared on the WhatsApp group. So there are certain free WhatsApp groups, and if you're not part of it, you can just WhatsApp me at +91 9877637809. So you can just drop a hi there and ask my team to add you into the WhatsApp group. So there you can access the handouts and the resources that are shared. Those who are already part of it, of course, there's no need of doing so. Now, the third rule is that please ask your queries patiently. Please ask queries which are relevant to the topic. For example, I don't want anyone to say that, ma'am, is this session recorded? I'm teaching financial instruments and you're asking me basic doubts like, is the session recorded? What goes for uh, IS 16? What is the rule for IS 38? I don't want you to ask out of context questions because that deteriorates my flow of teaching and it also impacts the other students in the session. And then I've heard a lot of people say, please repeat, right? So I do, with all the grace, accept that there are times where I might have to repeat. But the point is that we have a time crunched practice and revision today. So I cannot go on repeating the same concept again and again if I want to cover maximum number of concepts in one session. So with all due respect, I expect you guys to be okay with it. If you think that something does not fit you well in the first go, you will have the luxury of having a recording. Later on, you can come back to that topic in the recording and get your doubt clarified. Right? And then lastly, all you have to do is listen and participate actively. So sometimes I ask you counter questions. So you have to participate actively so that I know that you're listening. Right? And when I say listen, I mean, you are not supposed to type along with me. You're not supposed to take running notes because I'm going to provide you with the handout of the session. So there's no point that you would do it yourself. So these are certain basic rules of the session that I wanted to set apart before I begin with the class. Are we guys clear on this? Yes. Are we all clear on this? Okay. Is this session relevant to strategic business reporting? Yes. Is this session relevant to financial reporting? Yes. So there are certain aspects of FR which will be covered. So when I say that this is something which relates to SBR, this relates to something of FR. So you need to pay attention to that. And of course, AAA people can also take advantage of it. Okay. Even the people of diploma in IFRS, if you're planning to give it in future, you could also refer to this video as your revision. Again, this is a disclaimer, just like you have a disclaimer in most of the series that you watch. This is for revision and not preparation from the scratch. I don't want viewers or anyone to think that this is how I teach, this is how I rush with the subject or with the IFRSs, or this is the depth we have. Because reality is that we are just doing revision. We have our exam in the next few days, and you are all at that level that you have done the basics once. So we are just revising those basics once more in the class. So we are going to rush with the topics, we are going to just touch on them, and we are going to do the major aspects so that we know, okay, we know this from this particular IFRS. Correct? So let's get started. Let's first talk about non-current assets. Now, the non-current assets have various aspects to it. We have various standards like IS 16, we have IS 38, we have IS 40 investment property. Then we have impairment of the assets, IS 36. Then we have IS 20, which is on government grants. Then there is IS 23, borrowing cost. Then there is IFRS 5, non-current asset held for sale and discontinued operation. So these are the standards which we have also done in FR. So SBR students have done it in FR, and FR students are currently doing it. These are very important standards from the point of view for MCQs in FR, and even tested widely in SBR and even in AAA. So these are like evergreen standards. So we'll just touch on them a little. What we can do is we can cover these three standards together: IS 1638 and investment property. So let's do it together. Okay. So let's first talk about IS 16, then IS 38, then IS 40. So IS 16, as the name suggests, is for property, plant and equipment. IS 38 is for intangible assets. Intangible assets. Then we have the investment property. So these are the standards that we have. Okay. Let's have a look at them. First of all, initial treatment of all the standards is exactly same. That we record the asset at its cost. Cost includes purchase price, the price at which you bought the asset. Then you have directly attributable costs which are added or capitalized. Now, what are the directly attributable costs? Like cost of installation, cost of transport. Training cost is not a directly attributable cost because an asset is something that you control, and training cost is not something that you can control. So right now, how many people are here in the session? 209. Can I control 209 people, that what they are understanding from the session today and whether they are going to retain it and write it in the paper? I can't control it, right? So when I can't control it, it's not my asset. So training cost is not capitalized, right? And then we have irrecoverable taxes. So irrecoverable taxes are more like you have paid tax to someone, but you can't claim it back from the government because you are not registered for taxation. So let's suppose I have paid VAT. I can get or claim the VAT back if I am registered for VAT. But if I am not registered for VAT, I don't get that tax back. So that is irrecoverable tax. Just like that, we add borrowing cost. We have a standard on that. Then we add present value of future dismantling cost, right? So there are a lot of stuff which are coming under directly attributable costs. So we just copy this, and this is exactly same for intangible assets and investment property. That's the initial treatment. Now, subsequently, investment property has a different subsequent treatment, but it is same for IAS 16 and IAS 38. I have choice between cost model and revaluation model. So cost model, as the name suggests, I will keep the asset at carrying amount, which is cost minus depreciation minus impairment. And revaluation model is, there are certain rules of revaluation model. You take the asset to its fair value whenever necessary. That means whenever you feel that, okay, the fair value has increased or decreased significantly, then the fair value movement or fair value gain goes via OCI, and revaluation downwards goes via P&L, right? So this is what revaluation surplus is when you take it via OCI. And then you don't do revaluation on the basis of cherry picking. So cherry picking is not allowed. You have to, if you're revaluing one asset, you have to revalue the whole class of assets. So this is what we have as rules of revaluation model. And we do depreciate a revalued asset. So depreciate a revalued asset by using revalued amount divided by remaining life of the asset. Correct? This is what I have for revaluation model, which is same for intangible asset. So same as IAS 16. In IAS 38, we further have there are two types of intangible assets. One is definite life intangible asset. Second is indefinite life intangible asset. So the intangible asset with definite life, that has to be amortized over the life of asset. And the intangible asset without a definite life, for that I need to conduct annual impairment review. And then also in IAS 38, we have a concept of research and development. So what does the concept say? That research cost is expensed and development cost is capitalized. And how do I know what is development? Wherever pirate condition is met. Pirate is Pirate is probable future economic benefit, intention to complete the development, resources to complete, ability, technical feasibility, and a reliable estimate to do so. That's how I deal with research and development. Now for investment property, I also have two methods. Again, cost model is same as before. But then we have a new model, that is fair value model. In fair value model, you take the asset to its fair value at each reporting date. So you take it to its fair value at each reporting date, not just whenever necessary. You do not depreciate your asset. Why? Because you're not using it. It's basically investment property, something which is there for capital appreciation or for rentals. So you're not using it. So you do not depreciate it, right? And anyway, it is kept under fair value model. Then, if I have to take my asset to fair value at each reporting date, the movement will go via statement of profit and loss. Whether fair value upwards or fair value downwards, it is going to go via P&L. That's it. This is what I have for investment property IS 40. Are we guys clear on it? Basic points of these three standards. I hope you remember it. Yes, Priyanshi, investing section. No, Ria, impairment, as I said, takes place for indefinite life intangible assets anyway, without indicators. Okay. Again, as I said, repetition, that was the rule what we discussed. You can refer back to the recording. Excess depreciation is a policy which certain companies follow, okay? And that is basically due to revaluation upwards. There might be some more extra depreciation. So certain policies are made in certain companies that excess depreciation sometimes is taken out of revaluation surplus and taken to retained earnings. That's a reserve transfer. Okay. Now let's move on to another standard. Let's talk about IS 36, impairment of assets. So here impairment is reduction in value of the asset. Impairment happens when impairment happens or occurs when the recoverable amount of the asset is lower than its carrying value or carrying amount. You all know how to calculate carrying amount. How do you calculate recoverable amount is the question. So recoverable amount is higher of fair value less cost to sell and value in use. What is value in use? Present value of future cash flows. Now in SBR, you can get more specific questions for value in use. See, value in use is based on judgment, assumptions, projections, forecasts. So what kind of present value factor you have to use? You have to use pre-tax rate for value in use calculation. Then what kind of growth rate you have to assume for your projections of value in use? Either it is zero, declining, or constant. So either it is zero, declining, or constant. The growth rate, right? This is what we assume. Then once you are conducting impairment review, that's when you compare carrying amount and recoverable amount. But generally for any particular asset, impairment review is conducted whenever there are indicators of impairment. Only in case of goodwill, indefinite life intangible assets, impairment review is conducted annually. Otherwise, it is conducted whenever there is an indicator, right? Now, if the indicator exists, I will check the carrying amount and the recoverable amount, and I'll accordingly record my impairment loss. So first, the impairment loss is taken out of related revaluation surplus if available. And then secondly, the impairment loss is taken out from P&L. Right? That's how I record my impairment loss. Either it is taken out from revaluation surplus or I take it via P&L. Then we have a concept of cash generating unit. So cash generating unit is the smallest unit of identifiable. Identifiable means the assets which can be sold separately. Identifiable assets which cannot generate independent cash flows. So they cannot generate independent cash flows, but they can generate cash flows if they are taken together as a group. So in that case, if there's an impairment, first impairment is allocated to the damaged asset, second to the goodwill, third to rest of the non-current assets on pro rata basis. That's the rule. This is what you do for cash generating unit. Do you understand the impairment? Like, not understand, but do you understand the revision of impairment? It's a revision we are doing. Awesome. Can you tell me the full form of IFRS 5? What is the full form of IFRS 5? Non-current asset held for sale and discontinued operation. Very good. So IFRS 5, non-current asset held for sale and discontinued operations. So there are certain non-current asset which we might, be selling in the future. So those can be kept as held for sale. But for that, criteria needs to be met. What is the criteria? Caption, where C stands for commitment to sell, A stands for active plan to sell, then sale in present condition, then sale is probable, it will happen within 1 year, and there will be no change to the plan. If the caption criteria is met, then only a non-current asset can be held under IFRS 5. And once an asset is held under IFRS 5, I need to stop depreciating that asset because, of course, I'm going to sell it off. I'm not supposed to use that asset. I need to maintain its present condition. I need to take it to lower of cost and net realizable value because, of course, I'm going to sell this asset off. So what is lower, the cost or the net realizable value? That's what I'll take. And I will classify this asset as current asset now because I'm going to sell it within 1 year. So it has become current asset instead of non-current asset. Correct? This is the accounting treatment that I'm going to follow. Then there's a concept of discontinued operation. What do you know about the discontinued operation? What is the uh, definition of discontinued operation? See, we might in a business have various divisions, branches, departments. So we might be closing some of them. So basically, discontinued operation is when caption criteria is met, and we are talking about a separate major line of business, either due to its nature or due to its geography. Okay, either due to its nature or due to its geography. Or we can be talking about a subsidiary which was purchased initially, which was purchased initially with a view of reselling. With a view of reselling, right? So even that defines as discontinued operation. Now, what happens in discontinued operation is in your statement of profit and loss, as per IFRS 18, the new standard which was introduced, you have various activities in the P&L. Can you term those activities in the P&L as per IFRS 18? operating, investing, financing, taxation, and discontinued operations. These are the five activities in the P&L, right? So when I talk about this discontinued operation, that is coming from IFRS 5. And if something is classified as discontinued operation, then its profit after tax from discontinued operation is separately disclosed in the P&L. That's the rule. Rest everything is same, like stop depreciating the assets, lower of cost and NRV, treat everything as current asset. All of that still applies. So this is what we have for discontinued operation. Sometimes it is not a discontinued operation, but we are selling a group of assets together in a single transaction. Then we term it as disposal group. So that's basically when a group of assets are sold in one single transaction. That's what we call as disposal group. So this is the theory of IFRS 5, and that's what we have revised. Do we understand all of it till here? Yes, we all understand till here. Clear? So if in exam something comes up from these standards, you at least have something to write. Though I think that, you guys have done TYUs and you've done the lectures, so you must know more about these standards in detail. There's a lot more about these standards, but this is the crux. No, Aditi, that's different. That's just one group being sold together, so you don't do that disclosure of profit after tax. Yes, Mariam, you are right. No, Khushi. Disposal group is same as NCA held for sale. Disposal group is same, just like a lot of NCA held for sale together. It's not discontinued operation. Okay. Next, that's what we have from basics of our standards. Let's now get a little more technical. Let's discuss IFRS 15 revenue. Revenue from contracts with customers. So, guys, revenue is basically the income that you record from your normal course of business. So, that's one of the major keywords, that whatever you earn from normal course of business. So, if your work is to sell jewelry, what you earn by selling jewelry will be your revenue, not what you earn by selling property. But if you're a real estate agent, then what you earn by selling property will be your revenue, right? And then for that, we have 5-step approach. Number one is we need to identify the contract before we recognize the revenue. How do we know the contract exists? There will be rights and obligations on the sides of both the parties. One party will have the right and the obligation, right? So you must have settled the payment terms, and it should be like having a commercial substance. Commercial substance basically means we are not doing it for charity, we are doing it for profit. So we first identify the contract, and then we determine, or then we see What are the separate performance obligations within one contract? So here you basically see whether the performance obligations are distinct or not. So I hope you remember the question ZTech. I don't know SBR students have done it or not, or they remember it or not. But in SBR, there's a question ZTech where we consider whether two provisions we are giving under a contract are separate performance obligation or single performance obligation. So how do we know that they are distinct? There can be two different performance obligation. We have to see the seller's perspective and we have to see it from the buyer's perspective as well. So from the seller's perspective as well as buyer's perspective. If by both perspective the performance obligation is being satisfied individually and delivery of one is not dependent on the delivery of the other, then it is distinct. Otherwise, it is single performance obligation. Then after finding out what are the separate performance obligation, we are also supposed to determine the transaction price. How do you determine the transaction price? How do you determine the transaction price? You have various elements to it. You need to see, can you tell me the elements of transaction price? Variable consideration. What else? Variable consideration, non-cash consideration, financing component. One more thing, cash payable to customer. Very good. So what we have done in our studies is variable consideration could be there in a contract. How do we deal with it? We record it at expected value. That how much do you expect to receive? You probability weight. And then you have significant financing component. That's basically where you calculate the present value. And whenever you calculate present value, don't forget to unwind the interest. That means you are going to receive the money maybe later or you've received it in advance, whatever is the case. You have to calculate present value in that case. Then cash payable to customer. Now there are two aspects to it. Maybe you have paid cash to the customer because your customer was your supplier. In that case, you will record these two things separately. Your revenue is separate, your purchase is separate. Or you could have paid cash to the customer as a form of discount. That is treated as deduction from transaction price. That is treated as deduction from transaction price. Then we have uh, after cash payable to customer, we also have the non-cash consideration. That's more like barter system, where you basically say that I gave you an example in the class that, for example, you take SBR classes from me, and in return, uh, you give me editing services, right? So first, I will ask you, what is the fair value of your services? So first, what do you take into account? Fair value of goods and services received. fair value of goods and services received, right? And if that is not available, if that's not available, hmm, then I take fair value of goods and services provided as revenue. This is the rule. Then the fourth step in revenue recognition, the fourth step in revenue recognition is allocation of transaction price to the separate performance obligation. To the separate performance obligation. How do you allocate the transaction price? It's done on the basis of stand-alone selling prices. We do it on the basis of standalone selling prices and we prorate it. We use prorata basis for the allocation. And if standalone selling prices are not available from level 1, we go for level 2. If not level 2, we go for level 3. But we try to figure out what are the standalone selling prices, and that's how we decide what is the transaction price allocated to particular obligation. Then lastly, we have revenue recognition. Revenue recognition. What are the two ways in which you can record the revenue? What are the two ways we can record the revenue? At a point in time, over the period of time. When do you record the revenue? Ma'am, revenue is recorded whenever the control of the asset or control of the good is transferred or the performance obligation is satisfied. That can be done at a point in time or over the period of time. Whenever it is not over the period of time, it is at a point in time. So the question is, when do you record the revenue over the period of time? So if any of the following conditions are met, that's when you record it. If any of the following conditions are met, we record the revenue over the period of time. Number 1, if customer simultaneously receives and consumes the benefit. What was the example that we took in the class for this? It's you guys who are taking the advantage of the teaching. So teaching is one such example where the customer simultaneously receives and consumes the benefit. Second can be Wi-Fi connection, right? So as in when you get it, you consume it. You don't store it or you can't give it back to someone. Then the entity enhances, the entity enhances or creates an asset controlled by the customer, controlled slash owned by the customer. Because we can't be the Bob at the builder and we cannot take the asset that was constructed back in the middle. So I can't, in the middle of the construction say, no, I don't want to continue with this contract. I will take away all the stuff that I constructed with me, especially when the land belongs to the customer. So this gives me enforceable right to payment. Then when the entity enhances or creates an asset which is controlled slash owned by the entity, but entity has no alternate use. What was the example for it? Customized asset, customized goods. So if something is customized for a single customer, no one else will buy it, right? And in that case, also, we have an enforceable right to payment. And that is why the revenue should be recorded over the period of time. So these are the three conditions when the revenue is recognized OTP. And these are the 5 steps of revenue recognition. Do you all remember these? Yes. Markup is on cost, margin is on selling price. Any one of the 3 conditions, not all. Okay. Let's move on. Let's talk about sale and repurchase. Let's revise sale and repurchase. What were the rules associated with sale and repurchase? Hmm. If you sell something with an option to buy it back, there were few terms. One was call option. Okay, first was forward. Second was call option. Another was put option. Under put option, there were 2 further bifurcations: with obligation or without obligation. With or without obligation. Now the forward. What is forward? That I have made a promise that okay, I'm going to sell something, but I will buy it back in future. That is not a sale because you are going to buy it back, right? So the control has not been transferred. Call option. What is call option? Again, you have sold something, you have an option to call it back. In that case, again, it is not a sale because the control has not transferred. Then there is put option. What is put option? The buyer has an option to put it in front of you that take it back from me. Do you have an obligation to take that asset back if the buyer puts it in front of you? If yes, that means it's put option with obligation. Again, it is not a sale. However, if it is without obligation, it is a sale as per IFRS 15. Now, the question is if that transaction is not a sale, then what it is? If the original selling price, if the original selling price is greater than the repurchase price, hmm, then it is a lease. And if the original selling price or if the repurchase price is greater than the original selling price, that means you're going to pay extra, then it is a loan, secured loan. That's it. So this is what I have from sale and repurchase in IFRS 15. Are we all clear on IFRS 15? Yes, revised. Okay. Come to IFRS 16, leases. Contract modification is not that widely tested. So I would not suggest that you spend your time, such a precious time of 2 to 3 hours, which we have, on contract modification. Okay. Let's come to IFRS 16. The most important topic from IFRS 16 is sale and lease back. But before that, let me give you a brief on its initial accounting treatment and subsequent accounting treatment. So, initially in leases, a right of use asset is created and a lease liability is created. Generally, the lease liability is equivalent to present value of future lease payments, right? And for calculation of this present value, what rate do you use? Here we use, for present value calculation in leases, we use interest rate implicit in lease. And if that's not available, incremental borrowing rate is used. Correct? And how do you record the ROU? ROU is generally lease liability plus any payment made on or before the commencement of lease. So any payment made on or before the commencement of lease is also ROU. That means, for example, security deposit. We do pay a security deposit before we rent anything, right? So that also is usually capitalized in the ROU. Then subsequently, how do you treat it? Subsequently, what I have, I will depreciate my ROU. I will depreciate it over shorter of useful life and useful life of asset and lease term. And for lease liability, I'm going to unwind the interest because, of course, I've calculated it at present value. So I need to do unwinding. Then comes the concept of sale and lease back. In this first, I have to refer to IFRS 15 to decide if it is a sale or not. If it is a sale or not. So IFRS 15 tells you if it is a sale or not. We've discussed the 5 steps and sale and repurchase. You get to know about whether it is a sale or not. So it's like you sell your asset and then you take it back on rent. But the question is, see, having a legal stance, it is a sale. But economically, is it a sale or not? Because we follow economic substance over legal form. So there are two circumstances. It will either be a sale or not a sale. So circumstance number one, transfer is a sale. Transfer is a sale. Now, how I'm going to treat it in the books of the seller, who also becomes lessee, and how I'm going to treat it in the books of the buyer, who also gives the apartment on rent, which is lesser. So if transfer is a sale, the seller will, of course, de-recognize the asset. The seller would also recognize the financial asset that there will be a receivable or so, right? There will be a receivable or so which is recorded. And then lessee accounting will apply. So you'll record your right of use asset. How will you calculate right of use asset in this case? The retained portion is PV over FV into CA, which is present value of lease payments divided by fair value of the asset into the carrying amount of the asset. So you get to know what is the carrying amount of the asset which is retained. And then you record your lease liability. And then you get what? You get your profit or loss on disposal. After recording all of this, you get your profit or loss on disposal, right? And if transfer is above fair value, then the extra amount is recorded as financial liability. That means you have sold something or you have received something extra than its fair value. So that extra receipt of yours is your financial liability. And if the transfer is below fair value, if the transfer is below fair value, then that amount is treated as prepaid expense. That's your asset. This is what we do when transfer is a sale in the books of the seller slash lessee. Then what do you do in the books of the buyer if transfer is a sale? See, buyer will record the asset. He will recognize the purchase of asset. He will record a payable because money has to be paid if you buy something. And then you will do your normal lesser accounting. So lesser accounting depends upon whether it is operating lease or finance lease. So that's what you will do, right? Then there is second circumstance when transfer is not a sale. When transfer is not a sale. So when transfer is not a sale, we basically have two aspects to it. Number one aspect is the aspect of the seller, because legally the sale has happened and you have taken it back on rent, but economically it is not a sale. So you will not de-recognize your asset. That's the first step. Do not de-recognize. We'll say don't de-recognize the asset. Correct? And keep on recording the asset. You will not do any lessee accounting here. You'll keep on depreciating your asset as if depreciate the asset as if you are the owner. No lessee accounting. But since you are receiving rent and you have received money out of nowhere because you sold your asset, so that will be treated as a loan. So you'll record a financial liability, and the rent that you will receive or the rent that you will pay will be treated as interest on loan. Correct? That's what we have. Then what will the buyer do in this case? Slash lessor. Again, for him also, it is not a sale. So he will not recognize the asset. Okay. It's just that the buyer has given loan to someone. Loan to someone. So that is going to be treated as a financial asset, debt instrument. And whatever rent that you receive will be treated as interest income on loan. So it's like you've given loan to someone and you're earning interest on that. That's it. This is what we do when transfer is a sale and when transfer is not a sale. Do we all understand this? Revision. RN lease modification is very simple. During the lease term, if anything happens to the lease, we have to adjust our ROU and lease liability. So the adjustment has to go via that. That's it. That's the whole crux of lease modification. Yes, subleases. How many of you know about subleases? See, NEFR subleases is not tested, but in SBR it is. In AAA also, it's not that much important. See, what is subleases? Sublease is just simple concept made very difficult by certain words that have been used. It's just like, let's suppose there's a room, and I use this room as my classroom. So you guys must have gone to offline classes sometime in your childhood, tuition classes. So there was a classroom and a teacher was sitting and he was teaching in that particular room, right? Now that teacher does not stay there forever. Maybe he's there for from 5 p.m. to 8 p.m., right? Now the rest of the time that room is idle. So many teachers, they enter into such an arrangement. So let's suppose this is me, TG, and I have taken a classroom on rent from this person. So I become the lessee and this person is the head lesser because he has given that room on rent to me. But I know that I'll just use it from 5 to 8 p.m. So I rent it further to someone else. Let's suppose I rent it to Mr. XYZ. And that is for the rest of the hours. Like from 5 to 8, I will use it. Rest of the time, other person will use it. So I become intermediate lesser, or I become temporary lesser. And he becomes what? What is this person called as? He's also becoming the lessee. Yes, he's also becoming lessee, sub lessee. Very good. He's becoming sub lessee. So head lesser is this person. I am the intermediate lesser and the lessee, and he is the sub lessee. This is the concept of or arrangement of sublease, where the person living on rent has given his particular house or apartment on rent further. Now, what will be the accounting treatment? For the head lesser, he will do his normal lesser accounting without any doubt. The question is, how will I treat myself? Because I am lessee also and I am lesser also. So as a lessee, I will record my ROU and lease liability short. And as a lesser, I will see whether it's an operating lease or a finance lease. Generally, it will be an operating lease. So I will record my income in the statement of profit and loss for that particular year. That's it. How simple is that? That being TG, I will do two types of accounting. I will also be the lessee and I will also be the lesser. So I will also record my operating lease income and loss. Generally income, if I'm the lesser, I'm going to receive the rent, and I'll also become the lessee. That means I'll also record ROU and lease liability. Do you understand that? Okay. What if it is a finance lease? Good question. You apply your logic. What if it is a finance lease? What does the lessor do? He de-recognizes the asset in finance lease. That's what the accounting treatment is. Yes or no? But in this situation, do I have the asset with me that I will de-recognize it? TG is the intermediate lessor. She does not have the asset. She does not control the asset. But I do have ROU. So in that case, I will de-recognize my ROU. I will think that I have given my ROU on rent to someone. That is a finance lease. That's effectively that I have transferred my right to use asset to someone else. So I will de-recognize that ROU. But I'll keep on recording lease liability because at the end of the day, he's my head lesser and I have to pay rent to him. The fact is that I am getting that rent from someone else also, but that does not change the legal liability which I have towards Mr. whatever his name is, Mr. Head lesser. Yes, understood? So the key is instead of de-recognizing the asset, underlying asset, you de-recognize ROE. That's it. Yes, exactly, Karan. We record ROU in the way we record it for any lessee. There's nothing different in sublease. It's just an arrangement which examiner thought that maybe you guys are not aware about. Exactly, Satnam. That's true. Okay. That was IFRS 16. Okay. That was the crux of IFRS 16. Now let's revise IS 12 and then we are going to take a 10-minute break and continue with your favorite standard IFRS 9. So let us revise IS 12. Deferred taxation. So first of all, there are two types of taxes, current tax and deferred tax. In current tax, it's generally about over provision or under provision. So it's like you provide for taxes before and your return is filed later on. So you might have provided for your taxation less or more. So it could be under provided or over provided. Then you have deferred tax. So deferred tax is basically it's like arising due to generally the temporary difference. So we know that there are certain temporary differences like depreciation. So depreciation is charged by accounts and accountants, and capital allowance is given to us by taxation authorities. But the end goal of both the accountant and the tax authorities is to bring down the asset to its scrap value. So generally, there's a temporary difference. Now, if the in a given point carrying amount of the asset is greater than the tax base, that means today you will pay you pay taxes on tax base, so you will pay less tax. But tomorrow, once temporary difference is resolved, you will pay more tax. Thus, deferred tax liability is created. And if the carrying amount of the asset is lower than the tax base, this means you today you will pay more tax, but tomorrow you will pay less tax once the temporary difference is resolved, leading to deferred tax asset. Both DTA and DTL are created via statement of profit and loss. But there is a accounting principle, right? It's not a rule, it's a principle that yes, we do create the DT or the DTL via P&L, but if let's suppose the reason for the DTA or the reason for the temporary difference is going via OCI, then the related DT or DTL will also go via OCI. For example, in case of revaluation surplus, so that is taken via OCI, so its related DTL is also taken via OCI. Correct? Then one more important concept from IS 12 is unused tax losses, which is widely tested. So if you are making losses in a financial year, you can, the entity can claim exemption or claim the deduction for losses made in a year against the profits or against the future profits, which leads to future tax saving. So today's loss can lead to future tax saving. So on the tax to be saved, DTA is created for it. So if you know that your tax will be saved, by what amount will it save? You will create a deferred tax asset on that. Correct? So we are going to create a deferred tax asset on that. But the condition is that there must be a solid proof that future taxable profits will exist. And these proofs should be external, not internal. So they should not be like forecasts, budgets, projections. Instead, they will be something tangible, like a customer contract or something like that. So this is what we have from IS 12. Again, we are just revising. There are more parts and aspects to it, but this is the most widely tested crux of IS 12. Are we clear on it? Yes, this will be posted on YouTube. Are we all clear? In group accounts, if there is a fair value adjustment and depreciation and DTL are going to be calculated. See, if in groups you are acquiring a subsidiary and you're doing a fair value adjustment, of course, that fair value adjustment will create a DTL. So yes, a DTL is created. If there's a fair value downwards, a DTA is created. Right? Okay. Let's take a break of 10 minutes. Deferred tax implication as per IFRS 18 is you have to, in the P&L, in the taxation activity, that's where you show your deferred tax movement as a tax expense, right? So that's what is required as per IFRS 18. Okay. IS 12 and IFRS 2. See, that is something which is just there in SBR, which is not there in FR or AAA as such. Okay. No, Michael, that has nothing to do with leases. See, IFRS 2 and IS 12, let me clear you on that. Again, it's a small concept which is there just in SBR. So FR students don't get confused. In IFRS 2, we record our uh, expense, right? Remuneration expense. So basically, we are paying our employees in terms of shares or share-based payments like cash settled or equity settled share-based payment. So we do record an expense. Our entry is expense debit, equity or liability based on whether it is cash settled or equity settled credit. So now for equity settled share-based payment, the concept or the rule says that tax benefit is available at the uh, intrinsic value the day the share based payment is made. So it is available at the intrinsic value, which is always given in the question. So for equity settled share based payment, how do I get tax benefit? Because I've recorded an expense, right? So I can get a deduction of this expense in taxation. So I hope you know the concept of allowed and disallowed expenditure. So this expenditure can be allowed in future, but at intrinsic value. So what you do is you calculate your future tax benefit as number of employees who will get the share based payment into number of share options which will be granted into intrinsic value of the share option at that date, right? And this is what we record as a tax benefit into the tax rate, of course. That's what you will save. So this becomes your future tax benefit, and that's the amount of deferred tax asset that you record. Then you compare a very small concept. Once you've calculated this deferred tax asset, you see how much is the accumulated, how much is the accumulated remuneration expense that you have recorded with this share based payment regards. What is the accumulated remuneration expense that has been recorded with regards to this share based payment? You compare that with this tax benefit that you've calculated. So if that is greater, then that extra part is recorded via equity and the remaining via statement of profit and loss. On this, you can try the question splash. This is a TYU in your Kaplan text. Again, it's a very classic, in-depth concept, not widely tested, rarely tested. But since someone asked in the chat box, so I've again revised this with you. So you split it between what goes via equity and what goes via P&L. Are we sorted? Splash company, TYU. Yes. Agrata, most of the times it's given in the question, or you will have to calculate it as per IFRS 2. Okay. This is not the time to ask what kind of question you can expect out of IS 12. I mean, you've done so many questions in Super 20 as well, where we used unused tax losses. There's a question named halls, which is completely on IS 12. So we're just revising, right? So I hope you have done such questions. So let us take a break of 10 minutes, okay? Right? And then we are going to get back with IFRS 9. So let's take a break of 10 minutes and then get back with IFRS 9 with a clean slate. Yes, guys, I hope I'm audible to you. Okay, just give me a minute. Guys, you'll have to rejoin the same link in next like 1 or 2 minutes. Okay, just rejoin the same link. It might end up from here, so you'll have to rejoin. I'm not able to share my screen. Okay, say widely tested. Okay, so you don't know that sometimes there are certain circumstances that IFRS 9 is the most tested standard in the paper, even more than group accounts. Yes, there have been such times. We hope that does not happen with us, but we have to be ready for it. So now we are going to discuss IFRS 9 uh, from the basics till the advanced level. So you have to sit back straight and listen to me very, very carefully. Okay. So you have done this before also. When I will cover up the FR component, I will ask the FR students to have a break, but the SBR students will stay back. Okay. So let's discuss IFRS 9. Okay. IFRS 9, financial instruments. First thing that I need to know from IFRS 9 is that what are the types of financial instruments that we have? I have financial assets, I have financial liabilities, and then I have a concept of equity. So, equity, we all know share capital, share premium, retained earnings, all of that is equity. Basically, residual interest in the net assets of a company is equity, right? What is financial asset? See, financial asset is when you have a contractual right. So the keyword here is that it is a contractual right. It is not a general right that, okay, you have a right to do something, or you have a right to right by law, or you have a right by expectation. No, it's a contractual right. There is a proper contract, written, verbal, which gives you this right. Right to receive cash or another financial asset. That's what a financial asset means, that I will either receive cash or I will receive another financial asset which will favor me. There are two types of financial assets. One is debt instrument, okay? Another is equity instrument. One is debt instrument, another is equity instrument. So debt instrument is when you basically give loan to someone. You have given loan. You have not taken loan. You've given. Equity instrument is when you have invested in shares. When you basically invest in shares. That is equity instrument. Now, how do you treat with all the financial assets initially? What is the initial accounting treatment is the question. See, initially we record all the financial instruments at fair value. We capitalize the transaction cost unless subsequent method followed is fair value through P&L. So if subsequently I'm following fair value through P&L, then I will not capitalize the transaction cost, I will expense it. Otherwise, I'll capitalize it. That is initial treatment. Then you have subsequent treatment. So for debt instruments, there are three subsequent methods. Number one, amortized cost. Number two, fair value through OCI. And number three, fair value through P&L. These are the three subsequent methods. How do I decide between these three methods? I have two tests. Test number one, contractual cash flow test. Contractual cash flow test, which basically means that you get all the benefit. You get all the benefit in cash and not in kind. So you are getting all the benefit in cash, not in kind, which basically means there's no choice, there's no right. For example, if I say there's a convertible debenture. So convertible debenture means you have given loan to someone, so it's a debenture, but you have an option to convert it into shares. So you're not getting the payment just in cash. You're also getting an option to convert. That option is a benefit in kind. So there the contractual cash flow test is not met, right? And whenever the contractual cash flow test is not met, we choose for fair value through P&L method. So fair value through P&L is chosen when CCF test is not met. Now, if the CCF test is met, we move to the second test, that is business model test, where we talk about the intention. Intention basically means why do you have that particular asset with you? Are you going to keep it till maturity? Or are you going to play with it and sell it whenever you want? Or you are going to sell it for sure? So there can be three intentions. One is to keep it till maturity. So if CCF test is met and your intention is to keep it till maturity, the asset, then yes, amortized cost method will apply. That means I'll keep my asset at cost. And if I don't know situation, I don't know means I might keep it, I might sell it. There's no hard and fast rule. Then I will use fair value through OCI method. And if my intention is, even if when CCF test is met, if my intention is, what's the intention? That I will sell it in short term. If my intention is that I'll sell it in short term, then I will keep it under fair value through P&L. So this is how I decide the subsequent treatment. Correct? Cost, as the name suggests, we keep it at cost. Opening cost plus effective rate of interest minus the cash received gets you closing asset. Fair value through OCI, you take the fair value gain or loss via OCI. Fair value through P&L, you take the gain or loss via P&L. Now, debt instrument is where we have given loan to someone. That basically means uh, there can be some credit risk. There can be a possibility that the counterparty does not repay the loan. That is why concept of loss allowance arises. Loss allowances. It is just applicable on debt instrument kept under amortized cost and fair value through OCI. So here what happens in loss allowance? You are impairing your debt instrument. Now this is not something which is for FR students. This is for SBR students. Okay. So loss allowance, what do I have? I need to know the credit risk. Credit risk is risk of non-repayment. What if the counterparty does not repay? If the credit risk, if the credit risk has increased significantly, has increased significantly since inception, that means the day that asset was recorded in our books of accounts, if the credit risk has increased significantly, then I will create lifetime expected loss allowance, right? And if the credit risk has not increased, if the credit risk has not increased significantly, then I'm going to, since inception, then I'm going to create 12-month expected loss allowance. How do you create loss allowances? You create it via statement of P&L. So loss allowances are created via P&L, correct? And loss allowances are always at present value. So they are at present value. They are probability weighted as well. So these are the two characteristics of loss allowances. They will be first taken to the present value. Second, they will be probability weighted. So what is the probability that this loss will happen? Correct. And then you also have a concept of credit impairment. Credit impairment is basically when the counterparty has made sure that we are not going to repay you. There you don't create a loss allowance. Here your entry is P&L debit loss allowance credit. For loss allowance your entry is P&L debit loss allowance credit. And in credit impairment your entry is that particular asset is that particular asset is credited. So P&L debit asset credit. So you directly remove that from your asset. It's like a bad debt. This is provision for doubtful debt. Loss allowance is provision for doubtful debt. Credit impairment is bad debt. Sure shot. Then there is also concept of that we might require loss allowance on credit impaired asset. So something which was credit impaired, further loss allowance might be required there, right? So I need to see that what is the future probability that there will be loss allowances. There might be improvement. There might be improvement in the sense you expected to receive only $1,000, but now you expect to receive $1,200. So there can be improvement also. So all of that has to be taken into account. So loss allowance on credit impaired asset can also be created. Then there is a concept of purchase of originally credit impaired asset. So that's basically you bought something which was already credit impaired. So here we can say we have to use credit impairment adjusted rate. And generally in credit impairment, when you calculate your interest income, you calculate it at net amount. That's why I said P&L debit asset credit. That in other words means you take the net amount. In loss allowance, you take the gross amount. That means the interest income that you calculate is at the opening asset. And here in credit impairment, your interest income is at opening asset minus credit impairment. On the net amount, you calculate your interest, right? So when you purchase originally credit impaired asset, you just use a separate rate, which is given in the question, which is credit impairment adjusted rate. That's the only difference. So that's the touch on loss allowances. My question to you, in case of receivables, what kind of loss allowance is created? 12-month or lifetime? Why? Because, ma'am, usually the life of the receivable only is less than 12 months, maybe 3 months or 6 months. So there's no point of creating a 12-month expected loss allowance on it, right? So this is the crux of uh, IFRS 9 loss allowances. How does this affect IFRS 18? It does not impact IFRS 18. Like loss allowance created is on your investment, so it will go via investing activity, right? Okay. Next, equity instrument. Can you tell me the two subsequent treatments of how to deal with equity instruments? One is fair value through OCI, another is fair value through P&L. Fair value through P&L is by default method, okay? That's what we choose by default. Fair value through OCI is only chosen in two circumstances. Number one, the equity instrument must not be held for trading, must not be held for trading, okay? And and an irrevocable choice was made upon designation. An irrevocable choice was made upon designation. That's when you choose fair value through OCI, otherwise you choose fair value through P&L. Make sense? Then we have the concept of derivatives. Let's listen and learn about derivatives. See, derivatives are any contract, okay, which meets the following three conditions. Number one, they are settled at a future date. Hmm. Number two, they have initial zero or less value. Then their value is dependent on an underlying item. On an underlying item, right? So these are the three conditions that needs to be met before we call it as derivative. Now, once we understand that yes, this is a derivative, what is the accounting treatment? Derivatives are kept under fair value through P&L. Question is, can non-financial items be termed as derivatives? For example, an option to buy wheat or a future contract to buy wheat, to buy gas, a contract to buy gas. Like, for example, in Gas Nature Company, there's a question, Gas Nature in your Kaplan kit, SBR. Can it be termed as a derivative? That's the question. We can only term a non financial item as a derivative if it is settled net in cash. So, how do you know it is settled net in cash? Either it's written in the contract or It is a past practice to settle this contract net in cash, or you will take the delivery, you will take the delivery and then sell what you get delivered. So then sell and get cash, or what else? What you are getting is cash or cash equivalent. So it is kind of equivalent to cash, not exactly cash equivalent, but maybe it's a very short term asset. So it is equivalent to cash. So due to any reason, if it is settled net in cash, then only a non-financial item can be termed as derivative. Then can you take delivery of, can you take delivery of a derivative? Why do you get into a derivative transaction? You want to use it in the business? For example, a future contract to buy wheat. And let's suppose you are a baking company. So wheat is basically used in your company, right? So you're taking delivery of wheat. So you're going to use it in your business. So can you take delivery of a derivative? No. So we'll say derivatives are generally used for speculation, for speculation and not for taking delivery of the asset. If the intention of the entity, if the intention of the entity is to take the delivery, then the future contract, instead of derivative, is termed as executory contract because it's a future contract, right? But we are not doing it for speculation. So it is termed as executory contract, which will be settled on the day it is executed. So today you do nothing for it. If that's what your intention is, if you want to take delivery of the derivative. Correct? So this is about derivatives, executory contract, and uh, settling net in cash. Then finally, you have hedging. So in your doubt class, I have talked about hedging, the ones who are here from the batch. We've talked about hedging. So hedging generally is a phenomena or is an, you can say, action where you purposely, consciously, you identify something in your balance sheet, in your P&L, or a forecast transaction, future transaction, which you think is risky. Okay. So you want to hedge that risk. So you have a hedged item and you have a hedging instrument. So hedged item can be a recognized asset or liability, right? Or it can be a future probable transaction, highly forecasted transaction, or unrecognized firm commitment. So to hedge against that, you enter into a hedging instrument, right? That's the process of hedging. That's the process of hedging. And you document it as well. You document it that, okay, this is my hedging item, this is my hedged item and instrument. So if it is documented and the effectiveness criteria is also met. What is the effectiveness criteria? Number one, the hedged item and instrument have inverse economic relationship. Have inverse economic relationship. That means if one increases, the other decreases. Second, the fair value of hedged item is not dominated by credit risk. Third, the hedge ratio is apt. If these criteria are met, that's when we say the hedging is effective. Correct? Effectiveness criteria is met. And that's when hedge accounting rules apply. When the hedge accounting rules apply, no other standard is applicable. Only hedging is applicable. What are hedge accounting rules? There are two types of hedges. One is cash flow hedge, where you are worried about that how much cash you might end up paying because of some underlying changes. So, for example, you paying ACCA membership fees at the end of the year. So you know it today only that how much fee you have to pay. And you have an option to pay it right now as well, maybe. Let's suppose. In that case, you'll be like, if I pay it right now, how much will I pay? And you are worried that maybe the exchange rate can change for your adverse and you might end up paying more in your home currency. So you're worried about the cash flow. So here, the effective, what we do is the hedged item and instrument both are taken to their fair value, and the effective effective gain, or you can say the effective portion, goes to OCI, and ineffective portion goes to statement of profit and loss. Correct? What is effective ineffective? See, hedged item is the primary thing for which we brought instrument into the life. So I've given you the example of elder sibling. Generally, for the elder sibling, the younger one is brought into life because the elder one was getting bored. There was no one to play with. So the younger one was born that, okay, they both will play and there will be, they both will be able to entertain each other. Now, if the younger one troubles the parents more, parents generally say that, you are ineffective. The elder one does not trouble us that much the way you trouble. So the elder one is so sweet, so kind. We brought you to the world for him, and you trouble us more now. So similarly, if the gain or loss or the fair value movement on instrument is going to be greater than that on the item, then that extra movement is what we term as, that extra movement is ineffective portion. So the effective portion goes via OCI and ineffective portion goes via P&L. Correct? Then from fair value hedge, what you need to know? Fair value hedge, we are hedging against the movement of fair value. So again, hedged item and instrument both are taken to their fair value. And at the reporting date, you're taking them to the fair value. And the gain or loss goes via P&L. Gain or loss goes via statement of profit and loss. Okay. Only one exception is there where the gain or loss goes via OCI. What is that exception? When the hedged item was equity instrument kept under fair value through OCI. In that case, the gain or loss will also go via OCI for hedging. Rest every time it will go via P&L. That's it. This is what you should know from hedging and derivatives in IFRS 9 for SBR as well as AAA. Do we understand this? Yes. No, not that important. Okay. Now let's come to financial liability. How do you treat financial liabilities? Subsequent treatment. So there are two treatments. One is by default, amortized cost. Another is fair value through profit and loss. Amortized cost, you all know, opening liability plus interest minus cash paid gives you closing liability. Then you have fair value through P&L. When do you go for fair value through P&L method? We choose it when uh, liability is held for trading, or or we choose it when liability is held for trading or to avoid an accounting mismatch. For example, if a related investment property was kept under like fair value through P&L, so its related loan should also be kept under fair value through P&L. So that way, to avoid an accounting mismatch, we can keep it under fair value through P&L as well. That's it. So this is what I wanted to revise with you from IFRS 9. Okay. I hope we are clear. Uh, when you are afraid about cash flow mass, that's when it's cash flow hedge generally mentioned in the question, especially when you have a future probable transaction. That can't be fair value hedge. So that is generally cash flow hedge. Okay. We are not doing questions today. It's just a mere syllabus revision. But if you want to try question on hedging, you can try Artright Company. It will help you revise basics of derivatives and hedging. Artright. Okay. Let's move on. Let's move to another standard. Just SBR standard, IS 19 and IFRS 2. Then we'll move to group accounts. IS 19. Employee benefits. What is important from employee benefits is the fact the defined benefit pension scheme. Defined benefit pension scheme. So you all should know the format or the pro forma where you start your calculation with opening, surplus or deficit. Let me take deficit in this pro forma. Deficit is basically pension liability minus planned asset. In that, you add your service cost. So, service cost is added because that increases your liability. So, service cost can be current or past. It can be current service cost or past service cost, generally mentioned in the question. If there was any amendment, settlement, or curtailment, that gain or loss on settlement or that cost also goes via service cost. And this service cost is recorded in statement of P&L. Then in that you add net interest. From this, you deduct contributions into the planned asset. Because contribution into the planned asset increases my planned asset, right? Which decreases my deficit. Then benefits paid out, they have no impact. Then what you have apart from that? You have your closing deficit. So closing deficit is coming from the actuary. Actuary has given you this figure. So your figures does not match with that of the actuary, and the balancing figure that we get is remeasurement component. And this remeasurement component goes via other comprehensive income. Correct? This is what we have as a format of a defined benefit pension scheme, IS 19. Now, amendment, settlement, and curtailment. What's that? And what are the rules associated with it? Amendment, settlement, curtailment. See, you are supposed to pay some kind of pension to your employees, but you might amend your plan. So that can lead to some kind of gain or loss. That goes via service cost. Settlement is some people, they just leave the company, so you settle their claims before they leave. So that also gives you a gain or loss. Curtailment is when you lay off people. Sometimes you lay off them with settlement or without settlement. So that also gives you some kind of gain or loss. All of that goes via service cost. Then there's a concept of asset ceiling. If instead of deficit you have a situation of net surplus, now because we are prudent, we try to cap our surplus to certain amount. Because what is surplus? Surplus is when my planned asset is greater than pension obligation. And planned asset is what? Planned asset is an investment. So how will you get return from your investment? You have made an investment for your employee. So either you're going to get refund from that investment, or due to that investment, there will be decrease in your future contribution. Decrease in future contribution. Because basically, why have you or why do you have a planned asset? Because you want to meet your pension obligation. Now, if your planned asset has grown to such a value where you are surpassing your obligation, you will stop contributing further to the asset because you've already accumulated that fund. So the planned asset will give you benefit in terms that you will take the refund. That means after paying your employees, you will still have something in your pocket. Or you will reduce the future contribution into the planned asset. So you have to seal the surplus at whatever is the lower amount, is the refund or the decrease in future contribution, which is already always given in the question. That seal your asset up to this extent. So when you seal your asset, your entry is OCI debit, asset credit. So this also happens via remeasurement component. And remeasurement component is never reclassified to statement of profit and loss. That's it. This is what we have from IS 19. Also, one last rule: whenever amendment, settlement, curtailment happens, as per the revision in IS 19, we are supposed to revise the assumptions, the interest rates, uh, post plan amendment, settlement, and curtailment. So we have to amend our assumptions, judgments, and interest rates after the amendment, settlement, and curtailment. That's it. Do you understand IS 19? Okay. IFRS 2. Tell me the two types of share-based payments. Equity and cash settled. Correct. Let's talk about them. IFRS 2, share-based payment. Again, an SBR standard only. We have equity settled, share-based payment, and cash settled, share-based payment. So in equity settled share-based payment, share options or shares are granted to employees. And in cash settled, share appreciation rights. Share appreciation rights are granted, which basically means that the employees will get the payment in cash based on share price. So whatever will be the current share price going on the basis of that, they will exercise their SAR and they will get cash. That's cash settled share-based payment. So the entry for equity settled share-based payment is expense debit, equity credit. And the entry for cash settled share-based payment is expense debit and liability credit. Okay. Now, how do you calculate your expense or equity in this regard? What is the formula? In equity settled, the formula is how many number of employees who are getting the share-based payment into number of share options each employee have into fair value of share option at grant date. Okay. And then you also proportion it. Like, for example, the vesting period was 3 years. This is the first year out of the 3 years, or second year out of the 3 years, right? That's how we record it or calculate it. And for cash settled, what is the only difference in cash settled? You again take number of employees into number of SARs into fair value of share appreciation right at each reporting date. So above it was grant date, here it is reporting date. That's the only difference. And then here also 1/3, 2/3, 3/3. Then we have a concept of vesting condition. So employees will get these share options or share appreciation rights if they meet certain conditions, which are termed as vesting condition. So what are the vesting conditions here? There can be market conditions. So market conditions are something which are not in the hands of the employees, but they are in hands of like market. For example, interest rate, inflation, etc. So they are not in hands of the employees, but they are in hands of the market only. So for them, we don't actually, you know, we don't estimate how many employees will be able to meet these conditions. So they are already factored. They're already factored in the fair value of share option at grant date. Correct? And then there are non-market condition, which are basically to be met by employees, to be met by employees. So they do impact how many employees will actually get the share option. So based on the case study, you will decide how many employees are actually meeting the conditions. Correct? And then lastly, for cash settled share based payment, when we are settling the liability. So for cash settled, when the liability is settled, it is always paid in or on the basis of intrinsic value. It is always paid on the basis of intrinsic value, right? And not on the basis of fair value. That's it. Do we understand IFRS 2? Very simple two standards, IS 19 and IFRS 2. Just one point of difference. In equity settled, I take fair value of the share option at grant date. In cash settled, I take fair value at each reporting date. Are we all clear till here? Khushi, you will just reverse it. Whatever was recorded in equity, it will be transferred from equity to retained earnings. But that's not generally tested, so it's okay. Ceiling has already been explained. In IFRS 2, you don't have ceiling or something like that. IS 19 is about pension, IFRS 2 is about share based payment. They are two different standards, there's no similarity. So, how do we differentiate doesn't arise as a question. We've already considered current income tax implication on IFRS 2. When the share appreciation rights will collapse, nobody will exercise it. That's when you reverse it. Okay. Are we ready for the group accounts? Okay. Any payment that is on the, form of shares is a share based payment, even if it is for employee benefits. So IFRS 2 will apply to it. Let's talk about group accounts now. So here in group accounts, it's very important for you to know that what do you mean by control? That is something which is taken for granted by everyone. What do you mean by control? So there are three aspects to it. Number one, it is power over investee. which means you have right over variable returns. Variable means you might make a profit or a loss. So right over variable returns and ability to affect those returns. Correct? This is what I have as definition of control. Now, let us understand what are the circumstances where I might have control even if my voting right. So generally control exists when an entity has more than 50% of voting right. Correct? And there are, however, there are certain circumstances where control can exist even with lesser than 50% voting right. Even with lesser than 50% of the voting right. When can control exist? For example, if you appoint majority of board of directors, that's when control could exist, right? Uh, where else? Maybe rest of the investors are really small and scattered. So maybe they have a very less shareholding that they can't oppose you and they're very scattered, right? Or there are some special arrangements with other investors. For example, you have an arrangement with other 30% shareholder, you have 45%, but you have an arrangement with the 30% shareholder that you will vote on their behalf. So that is also like a special arrangement with other investor. Correct? Then what else do you have? Think about more. Majority board of directors, rest of the investors are small, scattered, special arrangement. What else? You make like you have key management personnel. So your entity is handling the key management personnel. So basically, it's about decision making. Who's actually making the decisions? That's what matters, and that person controls the entity. Now, if the control exists, I have to consolidate the accounts. So I have to consolidate statement of profit and loss. I have to consolidate statement of financial position, and I have to consolidate statement of cash flow. Correct? These are the three things that have to be consolidated. Now, when the consolidation happens for P&L, balance sheet, and cash flow, there are certain rules. For balance sheet, I'm going to talk about. First of all, you add up everything. That means you add up everything of the parent and the subsidiary as if you own everything. Correct? Then add up everything as if you own everything. Show up to the extent. Just a minute. Yeah. So add up everything as if you own everything. Then show up to the extent you don't own the show up to the extent you don't own the subsidiary. So that's basically NCI. So you have to show the NCR. Then eliminate the intra-group transaction and balances. So you have to eliminate intra-group transaction and balances. That's what you have to do as basics of your, you know, consolidation, right? Now, then we also have the 5 working notes for balance sheet itself. Let's discuss that. Let's discuss the 5 working notes for preparation of consolidated statement of financial position. So, preparation of statement of financial position. We have 5 working notes. Working note number 1. We talk about group structure. Basically, we identify who's the parent and who's the subsidiary. And there are times when you will have a confusion that who is the parent actually, who is the acquirer. So generally, when this question arises that who is the acquirer, we have some rules given to us under IFRS 3, which says that generally the acquirer is the one who is the bigger entity. Acquirer is the one who pays cash. Acquirer is the one who actually, you know, issues its own shares, issues issue its own shares, right? Then acquirer is generally someone who controls the combined entity, who controls the combined entity. That's basically generally what we mean by who's the acquirer. So there are times in the case study of SBR that you have to identify who's the acquirer, like we did questions of, I think there was this company named Bimbi and Lentil, and we were trying to figure out who is the acquirer, right? So there can be a direct question regarding this, like not direct, but application based theory question. Then we have working note number 2, which is for the net assets of the subsidiary. So you all know that the net assets of the subsidiary has to be recorded at fair value. So we take the net assets of the subsidiary at acquisition date, and we take the net assets of the subsidiary at reporting date. And the difference between the two is basically post acquisition movement, in which, you know, the working note number 4 and 5 will have their share. So working note number 3, then we have goodwill calculation. Also, I forgot to mention in working note number 2, if there's a fair value adjustment that happens at acquisition date column and reporting date column, a fair value adjustment can also lead to deferred tax asset or a deferred tax liability, right? If it is fair value upwards, it will be a DTL. If it is fair value downwards, it will be a DTA. Correct? And what else? The fair value adjustment can also lead to additional depreciation. This can even lead to additional depreciation in the reporting date column. Correct? That happens in working note number 2. Then working note number 3 is for goodwill. How do we start, or what are the 2 types of goodwill? One is full goodwill, one is proportionate goodwill. So first we take fair value of consideration paid. Fair value of consideration paid. Now that consideration can actually be like deferred consideration. So deferred consideration generally is recorded at present value. Then it can be contingent consideration. which is recorded at expected value. It can be share for share exchange. It can be cash consideration, any consideration. So fair value of consideration paid by the parent. In that we add NCI, right? We also add NCI here. Now, if it is full goodwill, I will take fair value of NCI for full goodwill. If it is proportionate goodwill, then I will take NCI as a percentage of working note number 2, and that will give me proportionate goodwill. Then from this, I'm going to deduct from working note number 2, I will get fair value of net assets of subsidiary. This is what I'm getting from working note number 2. And this will give me goodwill on acquisition. Then I might have to actually remove the impairment of goodwill and then get goodwill at reporting date. So I hope you remember the concept of total notional goodwill, SBR students. Because as I said in IS 36, there's a concept of CGU where in cash generating unit, impairment is also allocated to goodwill. So we have carrying amount of a CGU being compared to a recoverable amount of the CGU. So carrying amount of the CGU, if it is proportionate goodwill, that means it is just parents' goodwill. It is just parents' goodwill, right? It does not belong to NCI. It does not belong to NCI. It just belongs to the parent. Now, if it belongs to the parent, its impairment will also just belong to the parent, correct? And if the carrying amount of, in case of proportionate goodwill, just belongs to the parent, that means it is maybe just at 80%, because parent share is, let's suppose, 60%, 70%, or 80%. So it is partial goodwill. But the recoverable amount is coming from the market. And that is not partial. That is at full, 100%. So when I'm comparing the carrying amount with the recoverable amount, I cannot compare something which is at 80% with something which is at 100%. Then it will not be like for like comparison. So to make it like for like, I might have to gross up this goodwill by using unitary method and get a total notional goodwill for the sake of impairment calculation. So that is simply done as, if 80% of the goodwill is this, 1% will be this, 100% will be this. So that is working note number 3 and the concept of total notional goodwill. Then we have working note number 4. Let us see working note number 4. What is the working note number 4? Working note number 4 is for NCI. Non-controlling interest. So I first take NCI as per what I took in working note number 3. And then I add NCI share in post-acquisition profits of the subsidiary, which I calculated in working note number 2 again. Then NCI share in goodwill impairment if it is full goodwill. And that gives me NCI at reporting date. Correct? Then I have working note number 5. That is for group retained earnings. Here I start with parents' retained earnings. Then I share parents' share in post-acquisition movement of the subsidiary, which comes from working note number 2 again. Then if there was any unrealized profit, any intragroup transaction and stuff like that, especially where parent is the seller, that is being removed here, right? Then if there's an unwinding of interest, parent share of goodwill impairment, all of that, it comes here, and you get closing group retained earnings. That is very simple for the 5 working notes that we have. Basic group accounts. Are we clear on the 5 working notes? Make sense to all? Contingent consideration is probability weighted. You do not consider depreciation for DTA DTL. Depreciation happens at the reporting date. Fair value adjustment happens at the acquisition date. This is for not your answer writing, Videsh. This is just for your concept. You should at least know that there are these 5 things that we calculate so that you don't forget in pre-populated when you're dealing with consolidation. In impairment allocation, we gross up the goodwill, but when we charge impairment, don't we have to charge? Yes, yes, we have to charge share of parent only. Okay. What question has notional goodwill? I think it is sugar company. Sugar company has that notional goodwill concept. Okay. That is share for share exchange. Let's move on. Please, let's move on. This was basic group accounts. Let's come to advanced level of group accounts now. Okay. I am assuming you know intra-group transactions. Let's move to advanced group accounts. First, we'll talk about change in group structure. Let's talk about change in group structure. So here you have like a staircase. I always draw this staircase with Tom is moving up the heaven. This is the golden door of control. If you have 0% shares till 20% shares, it is a normal investment under IFRS 9. It's a financial asset. If your shareholding is from 20% to 50%, then it is an associate under IS 28 for which you do equity method of accounting. If you have crossed this golden door that is above 50%, then it is parent subsidiary. Now the point is that we don't jump from 0 to 51 or 51 to 0. We can go on bits and pieces. We can slowly climb up the stairs or down the stairs. So that process is step acquisition or step disposal. So let us first understand step acquisition. In step acquisition, there are 2 circumstances. Number 1, I move from no control to control. No control to control. So in that case, no control to control, I basically, let's suppose I was an associate, the company was my associate, and now it's a subsidiary. So I'll have to say bye to IS 28. So I'll take the investment in associate to its fair value with gain or loss reported in statement of profit and loss. Then I will derecognize my investment in associate, derecognize the investment in associate, and I will in fact, after derecognizing it, I will calculate my goodwill. on acquisition, and I will start the consolidation process. This is what I do when there is no control to control. So I will do line by line consolidation, basic consolidation rules. Then I can also move from control to control, where I already have more than 50% shares, but I'm acquiring more. For example, I had 60%, now I have 70%. That just leads to decrease in NCI. So for that, I pass a journal entry because I'm acquiring more shares, so money is going out. NCI is reducing. So NCI debit, money goes out, so bank credit. And you will calculate how much NCI is reducing using unitary method. So you will be given in the question what was the NCI. So you will say, okay, if 40% of NCI is this, 30% will be this. So you get to know what is the decrease in NCI. So NCI debit, bank credit because money goes out, and there can be a balancing figure which will go to other components of equity, which can be a gain or a loss. That is a balancing figure. This is the journal entry passed for control to control. Then you have step disposal. When you move down the stairs, when you sell off your shares in a company. Situation 1, control to control. So maybe you had 60% shares, now you're just left with 50, but you still have control. So you had 60, now you're left with 51. So you'll sell off 9%. So here again, this will lead to increase in NCI. So your journal entry will be simple. This time money comes in, so bank debit, NCI credit, and the balancing figure goes to OCE. Then the second situation is when I move from control to no control. Control to no control. Here basically what happens is I need to calculate my gain or loss on disposal in consolidated accounts. So we will apply happy sad formula. When you sell your subsidiary, when you sell the shares, the proceeds that you receive, you are happy about it. So proceeds that we receive, we are happy about it. So we add it. Now because we have sold the subsidiary, NCI has been removed. So are you happy to lose the NCI? Of course, yes, it's a headache. It has a credit balance. So NCI at disposal date, you're happy to lose it. Correct? What else you're happy about? If you still have some retained interest in NCI, sorry, in subsidiary. So fair value of retained interest. You're happy about it. So you're going to add it. What are you sad about? The goodwill that you're losing. So goodwill at disposal date, because you're selling your company, so you're losing the goodwill. You're sad about it, so you deduct it. It's a negative thing. Then you're also sad to lose the net assets of the subsidiary. So net assets of subsidiary at disposal date. Again, you are sad to lose it. This gives you net happiness or net sadness, which is net gain or loss, which is reported in group statement of profit and loss in case of when we move from control to no control. We understand this? Yes. Yes, Pratika, that depends upon the question. If they've not given you NCR directly, you can use that method. What is fair value of retained interest? It's given in the question. Okay, when you sold your subsidiary, so gain or loss on disposal of subsidiary should go under which activity? Yes, same treatment for proportionate. Investing, very right. Because that subsidiary in cash flow also, it goes into investing activity. Clear? Okay. Then lastly, let's discuss group foreign exchange. For this, you should must know that what is functional currency. You can get a question directly, functional currency. So that's basically currency of primary economic environment. Correct? And in case of foreign subsidiary, I need to first see whether the subsidiary is autonomous or not. If the subsidiary is autonomous, then factors, secondary, primary, and secondary factors will apply. If not, then parent's functional currency is same as subsidiary's functional currency. Now, what are primary and secondary factors to determine the functional currency? The currency in which, primary factor is the currency in which sales price is quoted, the currency in which you can say the uh, direct costs are incurred, the currency in which the competitive forces are operating, the currency in which competitive forces operate, right? And secondary factor is the currency in which loans are taken, indirect costs are incurred. Correct? This is what I have as my functional currency. Hmm. Now, if there's a foreign currency, foreign subsidiary whose functional currency is not same as the parent, so there will be retranslation which will happen. What are the rules of retranslation? All the assets and liabilities are retranslated using closing rate. All income and expenses are retranslated using average rate. And this difference of rates that we have might lead to some balancing figure, which is termed as retranslation reserve. And this retranslation reserve is taken via OCI and is reclassified to P&L only when the foreign subsidiary is sold, not before that, right? Only when foreign subsidiary is sold, that's when I can reclassify it, otherwise not. Make sense? This is the rule for group foreign exchange. Now there is one more concept of group accounts, that's group cash flow. But unfortunately, by conceptual basis, there's nothing much about cash flow, but its application is there. So if we talk about its application, make sure that when you are, uh, consolidating the cash flows, you do take that, okay, you have paid something to buy the subsidiary, so you should take it at net amount, that how much I've paid to acquire the subsidiary versus what was the cash brought in by the subsidiary. So you have to take into account that there was a subsidiary purchased during the year, there was a subsidiary sold during the year, which is why current assets and current liabilities are moving. So the current assets have not primarily increased or decreased because of cash movement. They have increased or decreased because of purchase or disposal of subsidiary. So you have to take all of that into account. And sometimes you have to make T-shaped accounts of associate to calculate the dividends received, dividend paid to NCI. Correct? Yes. So you can try for cash flows. The questions that we can try is Moise, Jocat. I think Cabello is also there. Just confirm if Cabello is cash flow or not. These are the three questions you can try from cash flow. But if you see your pre-mock, they have asked you statement of financial position only. And generally that is what is the favorite of the examiner. But because IFRS 18 was introduced, where we have new activities for statement of P&L, okay, I request you all to go through one video of mine, which is there in the YouTube live, the most recent YouTube live video of my channel. It talks about IFRS 18 and IFRS 19. And then there is a video which is there for current issues as well, where we talk about IFRS S1 and S2. So you just Google IFRS S1 and S2 and you will see my video. Watch these two videos, okay, in addition to this grand revision, which will make a lot of difference. Apart from these standards, there are a lot other standards also, like IS 37, IS 10, IFRS 8. So we are not touching on them because these are small standards. As I said in the beginning of the session today, we are going to do the major standards, which are like widely tested and are quite complex. So we've done IS 16, IS 38, IS 40, IFRS 5, IS 36, then IFRS 15, 16, IS 12, IFRS 9, IS 19, IFRS 2, and group accounts. That's like the major chunk of your syllabus. Rest everything is like small, it's important. There's no cherry picking to be done, but it's manageable. I hope we all are clear. Yes. Can we get a recording? Yes, of course. You'll get the recording of this session tomorrow on my YouTube channel, like in the afternoon hours. Okay. Joint arrangements. Okay. So there are two things. One is joint operation and another is joint venture. So joint venture is when you have opened up a new company together with other companies and you have unanimous voting there. That means there's no majority, there's unanimous voting. That means if we don't agree all together, we will not make a decision. So if you agree with me and we don't go by majority, it's like if five people are sitting in the room, all of them should agree with the decision, then only the decision will be exercised. That is unanimous consent. So if that exists, it's a joint venture on which IS 28 is applicable, where you do equity method of accounting. For joint operation, it's like there's no company, there is no unanimous consent. It's just that you started a operation, a basic activity together with someone else. So whatever is your share of income and expense, you record that, and the counterparty records their share of income and expense. That's joint operation versus joint venture. Yes, Ellen, there are so many such notes floating there on the groups. So you can just DM in anyone in the group and they would share the notes with you. Okay. YouTube channel by the name of Tashwita Gupta, TASHWITA. If you can just search, you'll find IFRS 18, 19, IFRS S1 and S2. These are very important things. Okay. Autonomous means independent, Khushi. A subsidiary is independent of the parent if it can make its own decisions. If it does not depend for finances on the parent. How are you autonomous of your parents? If you're financially dependent on them, you're not autonomous. Capital tax is written, take gain and loss on disposal of subsidiary in the operating section of the P&L. Okay. Pratika, there are two aspects. If you talk about group accounts, so in group accounts, it will go to operating. In individual accounts, it will go to investing. So there are two aspects to it. In group P&L versus individual P&L. Yeah, IFRS 18 will short be there. My main challenge is applying the standards concisely to the case and maximizing marks within limited time. So any. Okay, so fine. See, when I talk about your strategy ahead and the way you should be applying your concepts in the exam, just a small talk before I end the class. Let's talk about your strategy ahead and how to deal with questions in the exam. I don't know where you are at your preparation, like how many questions you've done, whether you've given mock or not. So, what I would suggest you is that SBR is such a subject where application is very important. You still have, uh, 4 or 5 days with you. So, 2 days before your exam, or 1.5 day before exam, you're not going to do any question. No questions are to be practiced. No questions to be practiced, okay? You are just going to revise the concept. So before the exam, 1.5 day, we are not going to do any questions. But before that, we can do questions. For my batch students, I've given you 2 mocks. Today was the last day to submit the second mock. First one is already given back to you. Second mock will be given back to you like by day after tomorrow. And you already have the debrief of the second mock also available with you on the portal now. So you have given 2 mocks. If someone has missed the mocks, make sure you write the mock. Very important. So what you can do is, if you have missed the mocks, you can do the September pre-mock by ACCA. And I will suggest you that watch ACCA's brief. If you go to ACCA's YouTube channel, there's a ACCA's video brief from the examiner or from top tutor regarding that pre-mock. I request you to watch that. It will help you to get a fresh perspective, and it will also help you to understand the examiner's POV as well. It is very small videos that ACC has posted for the 4 questions. You can watch that. You should and must watch that. Okay? So September pre-mock is compulsory for everyone to solve and then watch its debrief. Right? And then apart from that, that's the questions that you can do. You can do the pre-mock, you can do the any random mock that you want to do. Uh, you can do practice of random past papers if you have time in time pressure environment. And then 1.5 day before the exam, you have to just do concepts. From where are you going to do the concept? You can use this grand revision that happened today. You can use your notes, your source notes from wherever you've studied, any running notes that you made while watching the lectures. You can do that. You can visit your weak areas. Still, you have the time if you feel that, okay, my standard of IFRS 9 is unclear. You still have the time, half day, complete IFRS 9, each TYU, solve each TYU, and get a grasp over that. Right? So, this is what I would tell you, that this is how you're supposed to manage the days coming ahead. Now, how to answer in the exam? See, my answer writing technique, I have emphasized on it multiple times. Maybe you are someone who's attending the session for the first time because this is a free session. But for my batch and in general, in many of my YouTube videos also, I've emphasized a lot of times that SBR is all about that you first state the standard and then you apply the standard. First state the standard and then apply the standard. These are the two main things that you have to do. Sure, short. And how do you apply the standard? There are times when the application is not easy. I call those questions as bouncer questions. Then I pick up keywords from the requirements and I explain the keyword and I try to bridge the gap between the keywords and try to make sense out of it. For example, the requirement says how conceptual framework aligns with the choices offered by IS 16 for measurement. So, first I'll explain them conceptual framework. I'll explain them conceptual framework talks about measurement model. So, I'll first explain that measurement model. That how do I decide whether to go for cost model or for current value? It depends upon individual characteristics of the asset and liability, how they further, affect the cash flows, future cash flows. It depends on cost benefit analysis. Similarly, IR 16 also have two choices, cost model and revaluation model. And I choose between the two models on the basis of individual characteristics. If an asset is unique, it's difficult to find its fair value. So I go for cost model. So I'll try to make sense. And if I don't know anything, I'll just write conceptual framework talks about relevance and faithful representation. So in bouncer questions, I pick up keywords and I try to make sense out of it. I don't leave anything blank. Because SBR is a subject where you might feel that I'm failing, but you end up passing. Because you wrote the general stuff. Because you were not giving up on the question and you didn't leave anything blank. So anyone who completes the paper on time, writes the basic things which are relevant. Maybe the application is wrong, terribly wrong. You still have a chance of passing. And don't leave pre-populated blank as well. Pre-populated is like bonus cookie points. You have to solve it simultaneously. You have to solve the pre-populated simultaneously. What do you mean by that? When I'm doing exhibit 1 and I'm answering requirement 1, simultaneously I will make the adjustments in the pre-populated related to exhibit 1. So make sure that you are doing pre-populated. You get marks not just for the numbers, but also just for the posting of the entries. Now, I have shared with you, in the batch, I have shared the, if you have seen, I hope you have seen that there is a sheet or a PDF, okay, which has journal entries of the pre-populated for group accounts. I will also attach it along with this particular video's recording tomorrow. And meanwhile, uh, maybe someone can share it in the groups if somebody asks. But I think I've already shared it a few days ago, which is like a key to pass pre-populated. It has journal entries from group accounts. Correct? So this is what my strategy would be, or my advice would be for you guys, that please work on time management. Please deal with bouncer questions strategically. Don't leave anything blank. Write basic stuff. Try to write basic IFRS stuff in the question and get easy marks. And if something is very bouncer, then you can leave it and move on and manage your time. That's it. So, this is what I had to say for today. And I really hope that you guys have benefited from this particular session. And at the end, I would just say that I was having a little bad throat and cough and cold today. So it's been a week already. But I hope my energy levels were not too low for you to understand stuff. And you have actually benefited from the session. And I really hope that you guys pass. And next time when you interact with me or meet me anytime or text me, you guys give me a good news that we've passed with flying colors. And even if you don't, I'm always here to help. So, all the very best. May God bless you. And may you all pass with flying colors, is what I have to say to you. And it was a great batch. It's also the last note for my batch students as well. And it was a great batch at TG Professionals. The last thing which is remaining from my side is the mock 2 assessment. Today was the deadline for it. So now you will start receiving your scripts tomorrow. And that's it, right? You have the mock 2 debrief on the portal. Cash flow is not important for AAA. It's okay. So you have your mock debrief already on the portal. Pre-mock debrief, you'll watch ACCA's debrief, not mine. I'm not going to upload it. You'll watch ACCA's debrief. You have your mock 2 debrief on the portal already. Group link, okay. Uh, I'm putting my number here. Just drop a message here. The team will add you to the group. An automatic message goes, okay? Just drop a hi on the WhatsApp. I've put it in the chat box. So that's it, guys. Thank you so much. And yes, Apurva, thank you so much. All the very best. May God bless you. And read the answers carefully when you're solving a paper. Review your answers properly. And all the best. God bless. Take care, everyone. Bye.